With interest rates going up at a pretty good clip, many people who are in the home search are making the decision to head to the sidelines till things cool down. But how long could that take? If you're a regular listener of the SLO County Real Estate podcast with Hal Sweasey, you know the earlier you get into the market, the quicker you build equity. With so many people bowing out of the game, right now might be the best time to take advantage of less competition. Ermina Karim from Guaranteed Rate and Chad Van Til from Pacific Trust Mortgage joined the crew to go over financing options that buyers have outside of the regular 30-year fixed mortgage that will help combat rising interest rates and give you the opportunity to get the house you want. Without further ado, here's Hal Sweasey team member, James Bueno.
All right, everybody, welcome to another SLO County Real Estate with Hal Sweasey podcast. As always, we have Hal Sweasey. How are you doing, Hal?
I'm great, James. Thanks.
Mr. John Turner, JT.
Hey, James.
And JP from Keller Williams.
James, great to be here.
Today's a special day, Hal, and can you explain why that is?
We got a lot of questions about the mortgage industry and mortgage market, so we realized our limited capabilities there and brought in some specialists. I'm looking across the table at Ermina Karim, Vice President of Mortgage Lending for Guaranteed Rate, and I have Chad Van Til, who is the owner of Pacific Trust Mortgage. Ermina, can you tell us maybe a little bit about your background experience so the listeners know?
Absolutely. Thanks so much for having me here today.
Yeah.
I'm relatively new to the lending business. I've been working with Guaranteed Rate for the last 2 years. I'm partnered with a longtime lender, Donna Lewis, who's my business partner. She's been in the industry for 30 years.
Right.
My background prior to entering this is I ran the San Luis Obispo Chamber of Commerce for a number of years, and I have a background in finance, having worked on Wall Street, taking companies public.
Oh, great. Wow. Sounds like a great background. Perfect. Wonderful. And Mr. Van Til?
Yes, thanks again for having me here. Got into the business in 1994 and then started Pacific Trust Mortgage in 2002. We started out as a brokerage and then evolved into a correspondent lender or mortgage bank in 1995 and have been here headquartered on the Central Coast since that time.
Dude, you're throwing the heavy language out already. Correspondent lender. For those of us that don't know what that means, what does that mean?
Well, there's three really primary ways to go ahead and deliver a mortgage. As we probably all know, there's your retail bank that you go into if you walk into a Wells Fargo or a Bank of America. You can go in, sit down, and talk with one of the loan officers, get a loan. It's going to stay with Wells Fargo. You have Wells Fargo or Bank of America products, and that's what you're limited to.
Okay.
You have a mortgage broker who is a loan originator who is out on the street working with their relationships to go ahead and find their clients, bring in a loan application, do the pre-qualification, and then they'll usually send it off to a banking institution to go ahead and underwrite it, fund the loan, and go ahead and retain the servicing. And then there's a correspondent lender or a mortgage bank who typically will have originators that are out there that are also bringing in the loans, but they control the process a little bit more. They'll underwrite it, they'll draw the docs, they'll fund, and typically what they'll do is they'll sell it into the secondary market to a pool of different investors, so they offer a little bit larger variety of products and services and opportunities out there.
Okay, great.
What's happening in the mortgage side in the market right now? Can you guys talk to us a little bit about what's happening in San Luis Obispo County?
As we all are probably aware, that rates have gone up quite a bit since 6 months ago when we were at our historic lows. So we're certainly dealing with a little bit of change in the market when it's related to our buyers, because affordability with your increase of rates has decreased a bit. So from our standpoint, we're seeing people switching a little bit over to some of the alternative products where before, I think Ermina could agree that she was probably originating, and our company as well, 90% of what we were doing was fixed rates there, because we're at historic lows, so it was hard to not advise somebody to get into a fixed rate to go ahead and secure it for the long run. Now we are seeing some alternative products and more of the ARMs come into play. They're making a little bit more sense. For the past 2 years, you really didn't see too much of a spread between the fixed rates and the ARMs. So the savings were small.
ARMs being
adjustable mortgages, yes. So now you're seeing a pretty large gap between your fixed rate and adjustables, where it may make some sense to go ahead and look at some of the adjustable rate mortgages out there.
Roughly, what would be the difference today, and what would that look like?
I mean, you can definitely see a spread of over a point for sure, in or greater on the 1.5 actually on some of the things that we've been locking recently, and some of these offer 7 and 10 year fixed rate period at that lower rate, so it can make a lot of sense for a buyer to be able to afford the home and bet on where the market's going to go over time. And while it's been a bit of whiplash over the last 6 months, and there have been challenging conversations I'm sure you've also had, when we step back and we look at where we are today, let's just say in the 5s, Freddie Mac has put out average rates over the last, since 71, I want to say, and the 50-year rate is 7.8 between 1971 and 2021. The average mortgage rate, 7.8%. And so when you look at where we are, it's a shift in the market. There's no doubt about that, but we continue to be at a place that is low historically, just not as low as people were experiencing.
So we got accustomed to a lower rate. Now we get a little bit frustrated. So when the rate's higher, because you get used to it. Yeah. Is that why you guys keep wine in your office to give to your clients?
There it is.
It's all about today's rates versus what
pain a little bit, perceived pain.
Yeah.
We say this a lot. What is normal? What would you say is a normal rate, or is there such thing?
Well, I think as Ermina just quoted, over the past 50 years, you were looking in the 7s. I remember when I got into the business in the 90s, and we were doing cartwheels when we broke 8%. That was there, and it was exciting times there. And when we saw them in the 2s, obviously, it's been unprecedented. Nobody's seen anything like this. So 5% overall is still good money out there. It's just, once again, hard to swallow when we were looking at 2-3% only a handful of months ago.
Yeah.
Right.
You couldn't get that on a car when I was younger. It's amazing. What did I hear somebody say? So you got to deal with the reality. The truth will make you mad before it sets you free. But we're seeing it from my perspective. I think people have now kind of adjusted to it. So it's just like, okay, well, this is what mortgages are. We're going to deal with that. But the fact that you have those options sounds good. Do you guys do any of those I'll have you explain it, but like a 3-2-1, is that common? Because that was common, I don't know, in the early 90s or something like that. We used to see a lot of those where you get a fixed rate, but you buy it down over the term. Are you seeing any of that, or is that
coming back a little bit? We didn't see them the last couple of years because you couldn't do a 3-2-1 buy down when your rate was 2%. You'd be inverted interest rate. So so unfortunately, we didn't have any inverted interest rates to offer. But we are starting to see them coming back a little bit. We're also looking at some tools like 40-year amortization out there as well, which is a little more affordable for people to get into with that program. There's also interest-only loans out there as well that are interest only for the first 10 years and then fixed out for the last 30 years. So it offers some of that payment flexibility for those first initial 10 years, but also the stability of a fixed rate in case we do shoot up in rates. But as you can attest to more than anybody here, your average homeowner isn't in their home for 10 years for the most part. So looking at some of the adjustables right now, especially when you're getting into the first-time home buyers, the transition buyers, usually they're not going to see it even go to the term for the 7 years that Ermina was speaking about, the 5, 7, or 10 years that are your most typical adjustable rate periods.
It's interesting because for a long time, people didn't want to sell their homes, which were highly appreciated because they had this low tax rate, which is great. But then it's like, we would move, but we got this low tax rate. Now, if you have a 2.75 or a 3.25, that's going to limit our inventory because it's like, I don't want to let go of that.
You're sitting on it.
I really want to move, but I got this cheap rate. It almost landlocks, kind of people in their houses. So you said, Chad, and I'm not sure we agreed on this, you said the average person does not stay in their house 10 years. Or does?
Correct, does not.
Okay, they move before that.
Yes.
Yes. Okay. Yeah, I think it's longer than it used to be. But if that's the case, then you would do the John Turner strategy, right?
I'm going to do a 5, a 7, 1 adjustable rate mortgage because I know something's going to happen in my life where I'm not going to keep a 30-year mortgage. I'm going to move, or I'm going to need to maybe take some money out of my equity. Something's going to happen in my life.
And Ermina, so people know, what's a 5 or 7-1 that John was
Yeah,
saying? I mean, how do you
absolutely.
describe that to the first
Yeah,
time
absolutely.
borrower?
So, it's the period of which the mortgage is fixed. So the 5-year, 7-year, or 10-year fix. You'll see minor differences in rate for those periods. There are some different qualifications based on a 5-year versus a 7 or a 10. But essentially, it means that you are locked in at a lower introductory rate for that period of time for your 30-year loan, and then it ties to movement with a market index.
So I'm a first-time home buyer, and I've been looking for a year, and you know how hard it's been to find a house. Now I've found the house, and interest rates have gone up a couple of points, right, or more. What's the conversation look like when I'm sitting talking to you about how I proceed and how am I going to be able to afford this house because the rates are up? What's that conversation look like with you guys, and how do you coach me and advise me?
Well, you sit them down first with a glass of wine if they haven't been informed or in contact with you to brace from where the rates were. And it's really, starting with what they could afford. That's where we always, because there's a difference between what you could qualify for and what you could afford based on what your comfort level and budget is. And we go ahead and try to really work around what that comfort in their household budget is. And then really also try to talk about what their plan is for this house. Sometimes when you're doing a pre-qualification, it's hard to know what their exact plan is for the house if they haven't picked out the house. But usually if it's a first-time home buyer, they're getting into something that, once again, maybe for that 3 to 5 to 7 year period, because it's going to be a starter home. Maybe they're going to plan on having kids, so they may need an extra bedroom, and really try to go ahead and fit this home in their purchase into what their financial plan is, and really focus on really what it is they could afford, and then work into the product from there, whether it's the 3, the 5, or the 7 year fixed, or a 10 year fixed, or maybe it does need to be a 30 year fixed, because that's what's going to make them sleep best at night. Because some people just are very risk adverse, and they don't want to know that somewhere down the road that interest rate may change.
Chad, you had mentioned the 3-2-1 product. For the listeners that might not know what that is, what is that? What is a 3-2-1?
So basically, you're buying the interest rate down up front. So if your rate were to start at 5.5 is what the fully indexed rate is at the end, you would start off at a 3.5, and then the next year would go to a 4.5, and then it would go to a 5.5 rate. So you get some relief in those first couple of years.
I want to jump onto some of what Chad was saying as well. I mean, I think that when you're talking particularly to a first-time home buyer who's been, watching the market change in front of them, and hopefully, as Chad was referencing, you've already been having conversations along the way. They're tracking what's happening through their search process because you're partnered with them. We're partnered, lenders are partnered with agents to help serve the client. I think so much of it is also around addressing these myths we hold about buying a home in this country. I think there are myths around, well, you have to have 20% down. Well, no, you don't. Or myths like mortgage insurance is bad. Well, no, it's not necessarily bad. If it's going to help you, if you can, it can be a much more affordable option to get into a home and put less down, and rates can be actually quite attractive. Or you can buy out your mortgage insurance in front. And so there's so many tools. It's really the strategy that's going to fit somebody else's life and helping them to understand what the tools are available to them and confronting the storylines we may carry. There's a lot of shame in money also. And so helping people to understand you're not supposed to know this. It is not your business. It's our business, and we're here to help you with that.
Think about if you waited from 2018 to now to come up with that extra 10% down because they didn't want to carry that extra little bit of debt, what that costs, and not only the appreciation that they lost, but now also the cost of funds there as well.
Is it true today that many first-time home buyers are getting some help from somebody, maybe a parent or grandparent, and how does that factor into the qualification process today?
It's really straightforward. We see it with many of our clients are getting gifts from family largely. And it's a very natural part of the process. And so understanding what's available to them, making sure that they've had open conversations with whomever, that they're not also trying to guess what those figures are. It's a normal part of the lending process.
For those that were in the market that back in 2004, 5, and 6, when we're talking about 312s and ARMs, that differs dramatically from what was happening with lending practices back in that era. But can you talk a little bit about the difference and why those that might have been in the market now, they're saying, "Oh my gosh, these options are coming. Is this the turn? Is this happening again? Is 2008 going to happen?" These practices, lending practices, are way different than what happened back then.
I would say now we're probably of the strongest credit quality that we've certainly been in as long as I've been in the business. I mean, underwriting has been so stringent since the meltdown in 2008, whereas prior to those days, yes, there were some of the unique products that were going out. But you got to remember the underwriting standards were almost non-existent. That was there. You weren't verifying income. You weren't verifying down payments. People were looking at basically credit scores there. There was highly leveraged financing for these products at 95, even up to 100%. There was the deferred interest loans that were there so that people were allowed to go over what 100% of their value was. So the risk profile from underwriting was so different than where we are today. As I said, right now, the strength and the credit and quality of the mortgage-backed securities that are out there are, I think, as strong as they've ever been.
That's great to hear.
That's a huge factor in terms of people worrying about there being some sort of panic or the market shifting drastically in terms of pricing, and it just doesn't seem to be in the cards.
I don't see it happening because of the quality of mortgages that are there. Also, people not being able to afford it because a lot of these people before were banking on appreciation. They figure, well, I could hold it on a deferred interest loan that starts at 1%, and I'm going to hit my 10% appreciation per year, and then I'm going to sell and I'm going to walk away with $100,000 in appreciation. Yeah. And then when the market started tanking and they couldn't afford the mortgage, they had no choice but to give the keys back. Yeah. Now everybody needs to go ahead and down payment. You need to fully underwrite income. It's a completely different, as I said, quality of borrower that has been able to get into home ownership and loans over these last few years.
Yeah, makes sense.
So you're talking about quality of borrower. Are there programs, let's say I have a 650 or lower credit score, but I have a down payment. What other programs are out there for somebody with maybe not as great credit or not enough down payment? What's available?
Well, FHA is probably the one that's most commonly referenced for. You can go down to 3.5% down, and you can. It's more lenient on credit quality, and so you pay a higher price in your mortgage insurance, but ultimately it's a way that buyers can absolutely get into a home, and it's backed by the government. It's a strong program for the right borrower.
And I'll go a little bit backwards on what I was just saying, because there are some alternative programs that have recently come back that are called non-qualified mortgages out there, right, that are allowing a little bit more flexibility for borrowers here as well. The difference, I think, between with the non-qualified mortgages, their guidelines now versus in 2005, 6, 7, are that they're you still are having to underwrite income, but it is a little bit different than what Fannie Mae will require. You could do it through a different kind of bank statement showing cash flow, through 1099 income, through asset depletion programs, some things that are for well-qualified buyers that are still coming in with that 25, maybe 30% down, but they might be self-employed and have a little bit more of non-traditional income. So there are some avenues that are out there for somebody that isn't going to qualify for either an FHA or for a Fannie Mae or more traditional loan.
And the programs that Chad is referencing are, I would say, have a special appeal in this market. Our region is made up of small business owners, and there's a lot of self-employment in our community. What they're doing for taxes or whatever their situation may be can be more complicated to get through the loan process. So these products are a good fit for a number of borrowers in our community. Okay,
you guys are probably going to string me up for this question, but so I'm self-employed, right? Which is more difficult to get a loan normally.
Well,
it's not as straightforward.
Yeah, it's just usually a little more complexity based on the borrower and how many different entities they have versus somebody that has a W-2 and a pay stub. Right. There typically is just a little bit, it's more of a robust underwriting because you have a more complex financial situation.
Okay.
Right.
That's all I'm going to ask. That's good.
So, Ermina, a few minutes ago, you made a positive comment about PMI.
Yep.
You're probably the first person in the world I've ever heard make a positive comment. Can you? Maybe I just don't understand it well enough. Can you kind of explain what PMI is, and then maybe
Sure.
why you made a positive comment?
Sure.
About it?
Well, let me say that my what you interpreted as positive was don't be afraid of it, and I guess so. PMI, private mortgage insurance, is, for the lender if you're putting down less than 20%. And so it definitely has, because we have this myth that we need to save for 20% down, the balance. So something less than 20%, you have to get mortgage insurance. There are numerous scenarios, and it's tied to your quality so the price of your mortgage insurance will be improved, meaning lesser, based on the quality of your credit and the percent down you're going to put into the transaction. So depending on a client's goals, if you are focused on, for example, maximizing cash conservation, for example, it can often make sense to put 15% down, for example, save that 5% that you're not putting into a transaction, which at our home prices is a significant dollar amount. And if your credit's decent, you can buy out your mortgage insurance up front at closing for, say a $500,000 loan and your credit score's 750, you're looking at probably just a couple $1,000s to buy out that mortgage insurance up front, so you're never paying it. As long as you can carry that loan, you've conserved your cash, you can put that money to use maybe in a different way and not take a hit on rate. In fact, the rate can be quite attractive at 15% down. So I think, in addition to what Chad previously referenced, sitting out in the market waiting versus paying the monthly mortgage insurance, you're losing out on the appreciation and the value of that dollar to really put your money to the best use possible. So I would say don't be afraid and talk to your lender.
Great. Thank you.
And Ermina pointed out here, which is spot on, that sometimes it's strategic to do that, to keep that cash. And a lot of times that we're seeing it in the purchases is for improvements to the house. Because a lot of times you're buying something that you said, I'm stretched at 20%, but sometimes it makes a lot of sense to put that 15, pay that little tad bit of mortgage insurance, keep that cash to get the house livable. And maybe that helps you stretch into that purchase price that you wanted.
Can you help me do that with my fire and auto insurance? I mean, that sounds like a great... seriously, pay a small amount. Yeah.
Chad, Ermina, thank you for being on the SLO County Real Estate with the Hal Sweasey podcast. Do you want to let everybody know how they can get a hold of you in case they're looking for some lending help? Sure.
You can reach me, Chad Van Til, at Pacific Trust Mortgage at 805-543-4422, or our website is pacifictrustmortgage.com.
And you can reach me, Ermina Karim, at Guaranteed Rate. My phone number is 805-602-0248. And you can email me at any time, or my partner, Donna Lewis, which is donna.ermina, ERMINA, at rate.com.
We'll see you next week for some more great information. Thank you for listening to the Hal Sweasey podcast. Be sure to subscribe and rate this podcast. It comes out every Monday, so check for it in your feed for the latest information on the San Luis Obispo County market. The SLO County Real Estate with Hal Sweasey podcast is available wherever you get your podcast and on halsweasey.com, where you can find current listings and other real estate tips. halsweasey.com, that's HALSWEASEY.com. I am James Bueno, Director of Marketing for the Hal Sweasey Group. If you're looking for anything real estate, give us a call, 805-781-3750.
Hal Sweasey is a licensed California real estate broker. DRE number 01111-911. The SLO County Real Estate with Hal Sweasey podcast is a production of AGM Podcasts. Subscribe wherever you get your podcasts.